Welcome back, everybody. It's time to look for new positions and track some more transactions, so let's get right to it. We're back now in our four-part series of the SoFi wheel. This is part 3, and we had just gotten assigned on our 100 shares, so now we need to look to sell a covered call on those 100 shares we own and also look to sell a cash secured put so we can play both sides. So we need to go over to Thinkorswim right now to do that. All right, so it's setting at 1430. So we need to come back over to the trade tab. It's already setting on SoFi. And we are looking to sell a covered call for our cost basis, which is 1450. And look at that spread. The spread is the difference between the bid and ask. 31 cents to 100 to $1.04. That's crazy. So who knows what it's going to actually fill for. And we'll go ahead and play the game with I need to clear that off. We'll go ahead and play the game with the on demand and try and set a limit price. Oh, see there, it finally cleared up. Yeah, the $1.04 was way out of bounds. It shouldn't have been that high. But in any case, okay, so let's go and try this. We'll do 31 cents and I'll bump it up a little bit to the mark is like 34. So we'll try 34. And what we're doing is we're just selling the covered call for the 1450 strike. So let's go ahead and do that. Confirm and send. Man, that filled almost immediately. So that's pretty cool. And this green one is just from us simulating buying the stock. So you can ignore that for now. But there's the option purchase. And as I like to do all the time, is not only do I sell the covered call, but I also turn around and sell another cash secured put on it at the same time. So here, let's see. So I will say it's like the extrinsic is a little bit more than that. So wait, now they're about the same. Now it's more. It's always jumping around. But let's go ahead and just sell the $14 one. And the mark there is what is the mark? 23 cents. So we'll just bump that up to 23. We'll sell the cash secured put at the $14 strike price. So now and that filled immediately. Well, today it didn't have any problems filling last week it wouldn't fill at all. I had to sell a market one for it to fill. So in any case, there we go. Now we have the cash secured put and the covered call. So we're playing both sides. So if it goes above 1450, we get to pocket the money from the $14 cash secured put because it will expire worthless. And the 1450 will expire in the money. If it closes at the end of the week above 1450, our shares will get called away, but we still, get to keep the premium. And since our cost basis was setting at 1450, we'll basically break even on the stock, but we'll get to pocket all of the premium in the process. So now that we have sold our covered call and sold the cash secured put, we need to jump back over to the web application and track these transactions. So let's go do that right now. So here we are on the web application, MyATMM.com. We're setting on the dashboard. We're already in the SoFi demo portfolio, so that's good. We need to go over to the cost basis page. SoFi is already selected, and we need to enter the covered call and the cash secured put that we just sold over on Thinkorswim. So we need to click on new position. The virtual date is back in June. Let's go back over to June here. And it will be June 16th because that will have been, we basically sold the cash secured put initially on the 9th. It expired in the money on the 13th. So it was assigned over the weekend. And now we have 100 shares that we now own on the 16th. So we sold the covered call and the cash secured put on the 16th. So we'll click the 16th. It'll be a sell to open. We will do the covered call first. It was one contract. The expiration date will be that following the following Friday. We go back to June. We sold it on the 16th. The expiration will be on the 20th. And again, the UI knows that that's a date in the past, so it's marking it as such. And the covered call was for $14.50, if I remember correctly. Yep, that's right. And the premium we received for that was 34 cents or $34. So that's a 2.34% ROI. When we click save, it will move into, this is a call, so it'll move into the calls section. So click save, and you can see it moved into the calls. And now we also need to add a transaction for that cash secured put. So let's go back to June. And I know I didn't add the transaction yet. We're going to just add them both together at the same time, or one after the other. So June 16th, it'll be a sell to open. It was a put. We did one contract. Again, the expiration is back June 2025 on that 20th. The strike for this one was 14, and we received 23 cents or 1.64% ROI on that. When we click save, it'll move into puts. And so there we go. Now we have the put and we have the call represented in the positions in play. And now we also see that the proposed records were already, basically when I initially saved that draft position, it automatically created these proposed records. And this is just a staging area. I mean, you could ignore it, you could clear it. It doesn't do anything if you just ignore it. It doesn't matter. But what this will allow you is it'll allow you to basically assess what the commission and fees were based off that credit premium, so you can get the actual accurate number that was, put into your account. So here is the one for, what was this for? This is for the call. So this is for the covered call. So we'll just go ahead and click copy, and you'll see how it does a 34 minus 50 minus 1 and gives you the accurate credit that you received there. We'll click add transaction. That'll move it down to the permanent transaction history. And now we need to do this right here, the put, the cash secured put that we sold as well. Move that down. See how it does the math for you again. 2249. We'll click add, and that'll put it down into permanent transaction history. So now you can see we have the initial cash secured put that we did originally to get this ball rolling. This was the assignment, so we got assigned the stock, so we had to buy it. And this is when we turned around and sold the covered call right here, and we sold the cash secured put right here for the 2249. So now we have all the transactions caught up to where we currently are in the wheel series. And you can see we have the 100 shares owned from the original cash secured put that got assigned, and the one that we sold just now. So this is the 100 shares from the cash secured put that we just sold. So both of those are represented. Shows us the cost, shows us the collateral. And since the cash secured put was only $14, now our collateral is only $1,400. Total credits we received this entire time is $107. And the stock value, again, this is misleading because this is real time based off of today's date, March. So it wouldn't be accurate for this virtual demo. But more importantly are these three numbers, these cost basis numbers. So the current cost basis of just our stock purchase, which we've only purchased from that one contract. So we only own 100 shares. Sorry. So we own them at $14.50. If we calculated our premiums that we received into the mix, our cost basis is setting at $13.43. So that's our net. If we wanted to get out of this position with break even from the stock purchase and break even from all the premiums we received, we'd need to sell it for at least $13.43, and then we could get out of it break even, but making zero. That's what that number represents. If we want to keep the profit, we need to sell it for that. And this cost basis with put, since we're selling cash secured put, this again is just speculative. So if we bought, like at the end of this week, if this expired below the $14 strike, then we would have to purchase it. It would have been expiring in the money. The cash secured put would be. So we'd have to buy it. So we'd have to buy another 100 shares only at $14 a share instead of the $14.50. So now we would own 200 shares. Well, if that happened, our cost basis without premium would be $14.25. So this is also known as dollar cost averaging. We basically are buying more shares for less than we previously owned them for. So it's bringing our overall cost basis down from $14.50 to $14.25. That's what this cost basis with puts means. So let's see here. I just realized another number that you guys may be seeing. This was added recently, but as the tooltip says, this is the cost basis, but it excludes realized gains and losses. It's the pure acquisition cost of the remaining shares. The reason why this was added is because over time, you'll buy and sell a lot more shares, and you'll have some realized gains and realized losses in there as well. Well, this number basically excludes the gains and losses, so you can get a straight up cost basis without any of those numbers messing with it. And the reason why that messes with it is because it's following a first in, first out principle. So something that can really jerk around the numbers is if you happen to buy a stock for like $50 a share, but you end up selling it down the road and I know this goes against, the whole philosophy of never selling below your cost basis, but it happens. People do it. Um, Sometimes they accidentally do it and they didn't mean to because they can't get out of the option position or whatever the case may be. But in any case, if you bought it at 50 and sold it for 10, but your average cost basis is only like 20, it's not that 50 that you originally bought it for. Well, first in, first out will actually show it as if you did lose the $40 difference. So this cost basis without that first in, first out mess paints an easier to look at picture. Because overall, once you average that out, you won't have experienced that huge loss at the beginning. It's confusing, I know, but that's how first in, first out works. It doesn't take your average cost basis. It actually shows a loss based off of whatever the initial shares that you bought were. And Schwab actually goes by this. A lot of brokerages actually go by this to calculate your realized gain and losses. It goes off of the first in, first out accounting principle. This is not tax advice by any means, but that's what this number is for. For all intents and purposes, you mainly can just ignore this one. These three are the primary bread and butter, but this just gave another level of accuracy based off of, whatever history that this stock ticker had gone. Because some of the stock tickers that I've been trading, for almost, a few years now. So it has a lot of history, a lot of realized gains, losses, a lot of option premium, a lot of dividend, just a whole mess of stuff. So this was to get a finer level of granularity and accuracy is why this field was added. But like I said, for the most part, you can ignore it. But that wraps up part 3. In part 4, we will basically see what happens with the stock position, see if these cash secured puts and covered calls expire in or out of the money and what happens. And we will wrap it up with the overall dashboard and show you how the performance and everything turns out. Until then, I want to thank you for watching. Like and subscribe if you haven't already, and go out today to MyATMM.com and get your free account so you can start tracking your own transactions. Thanks, and I'll see you in the next one.